Even in my worst case scenario, barring an asteroid striking the Earth, PayPal stock is 50% undervalued today. This makes PayPal one of my top 5 value stocks, maybe even top 1. And if Alex Chriss, PayPal's new CEO, has anything to do with it, PayPal will become a growth stock again, which will make today's price ludicrous. I've done a full DCF valuation. Let's discuss that valuation model in this video. Hello, and welcome back to Finance Ninja. I'm Brian. If you haven't seen my previous PayPal video, check it out. These videos don't really overlap. If you have seen my previous PayPal video, I'm focusing on some different areas in this one, especially my valuation model. If you want to skip to the end, go right ahead. You won't hurt my feelings. Remember, this is not financial advice, just a thoughtful analysis. Let's get started. First, let's start with a quick overview of PayPal. PayPal, the digital payments behemoth, got a new CEO late last year because, let's face it, the last one sucked. Alex Chriss, a seasoned executive from Intuit, was the successor. So, who was Alex Chriss? Well, he was a senior executive at Intuit with extensive experience in global payments, product, and technology. He's been with Intuit for almost 2 decades and has a proven track record of driving growth and innovation. During his time as the head of Intuit's small business and self-employment segments, he oversaw a 20% CAGR in customers and a 23% CAGR in revenue. He also led the $12 billion acquisition of MailChimp. What PayPal was missing was small business, mom and pop shops. Alex is the man for the job. In case you didn't know what Intuit is, they make TurboTax. Going back to PayPal, one of the changes he has made is to organize PayPal into 3 subunits: consumer, small business, and large enterprise. This move should help better organize, coordinate, provide accountability, and eliminate redundancy. Xiaomao, I'm recording. How did you sneak in? Xiaomao says to like and subscribe. PayPal has been through a number of changes recently. Huge changes, major changes. The company has been restructuring and laying off employees to focus on projects like passwordless checkout and one-click in-app experiences. It's clear that PayPal is looking to adapt and stay competitive in the ever-evolving payments landscape. And it is a fiercely competitive landscape. So what can we expect to see under the leadership of Alex Chriss? Well, one of the first things he's likely to focus on is reigniting Wall Street's love for PayPal stock. He'll also need to address the competition and the payment space and continue to be innovative. Some key focuses for PayPal's future include maintaining a strong focus on the payment button, which is more lucrative than the back end, and expanding margins. There's also need to balance the unbranded and branded checkout services, as this has been a point of contention in the past. Now, the appointment of Alex Chriss as PayPal's new CEO marks a new chapter for the company. With his extensive experience and proven track record, we can expect to see some exciting changes and innovations in the digital payment space. What happens when the company spends less? We get more buybacks, more money. $5.4 billion in buybacks in the last 12 months, reducing weighted average shares by 5%. Who does this? Who can afford this? Not many. I can name a few, but it's not many. And not only do PayPal and Venmo, they also own Braintree, which does business transactions. Don't worry, the valuation model is coming up soon. For those of you who may not know, Venmo is a popular mobile payment service that allows you to send and receive money with ease. It's like having a digital wallet right in your pocket. Venmo's business model is based on a simple concept: make it easy for people to send, and receive money. This company makes money by charging fees for certain types of transactions, such as instant transfers and credit card payments. Now, Venmo isn't the only player in the mobile space game, or the mobile payments game. There are several other companies, such as Cash App, that offer similar services. This means that Venmo faces stiff competition, which could impact its growth and profitability. With Alex's focus on small business, I have to talk about Zettle. Zettle is a Swedish financial company that was founded in 2010. The company is known for its innovative products, such as the Zettle card reader and the Zettle POS system, which have made it easier for small and medium-sized businesses to accept card payments and manage their sales. I mean, it does inventories. Basically PayPal took Square's playbook and are replaying it, trying to capture as much share as they can. Now, PayPal acquired Zettle in 2013. The company has recently introduced a feature that allows Android users to make purchases quickly through its point-of-sale systems. This is a great example of how Zettle is investing in new product features to cater to the growing demand for contactless payments. Can you see my cat? She's right there. Right there. And she's adorable. My Patreon special is only $1, locked in for life. I promise. You will get access to all of my investment reports and spreadsheets. I've got Tesla, I've got Nvidia, I've got AMD, I've got Microsoft, and many others. And PayPal. You'll also get exclusive access to my Patreon portfolio. Every transaction I make will be posted on Patreon as it happens. You can follow every move I make in this account. Watch in real time as I grow this into a multi-million-dollar portfolio. You will never find a better deal. It has only a few seats left. Get in before it's too late. The link is in the description. Let me hide my face, because you want to see numbers, right? And numbers. So yeah, let's go over last quarter's numbers. Just real quick. I kind of went over this in the last video, but I think it's worthwhile to go over just one more time. Revenue, $7.4 billion, up 8%. Non-transaction related expenses down 12%. Non-GAAP EPS $1.30. That's actually up 20%. So the bottom line is actually growing faster than the top line, which means that margins are expanding, which is a great thing. Total payment value, $388 billion, up 15%. Repurchased $1.4 billion in shares, and I discussed repurchases previously, so I'll skip that. Divested happy returns for $465 million in cash. FY23 GAAP EPS expectations up 21%. Share repurchases I discussed. Revenue expected to grow 7 to 8%. And non-GAAP EPS growth of 10%. Now, of course, there are some risks involved. The two biggest are, number one, competition. PayPal's single biggest risk is the extremely competitive global payments industry in which it faces both larger, more dominant companies and smaller, agile competitors. Some competitors include Visa, MasterCard, Google Pay, Apple Pay, Square, Stripe, and Zelle. I don't like Zelle, but they are competition. The second big exclam is regulations. The industry is rapidly changing and faces increasing scrutiny and oversight from regulators. Next up is financials, then my valuation model. Didn't change. Oh, sorry, my slides weren't changing. Okay, here's the guidance. Here's the exclam. And here's the income statement. Okay, here we go. So yeah, while not recent any longer, the impact of COVID still affects PayPal to this day. During the height of COVID, people switched to online payments instead of in-store. This greatly grew growth at PayPal, with revenues growing 20.7% in 2020 and 18.3% in 2021. This accelerated growth caused PayPal stock to skyrocket to over $300 per share in 2021. That wasn't to last, however. The global pandemic reopening, with growth slumping to 8.5% in 2022. Now, PayPal shares have since slumped significantly, currently trading at $60 per share, an 80% drop from the highs. You have to go back to 2017 to see the stock at levels this low. You can clearly see the troubles the company went through in 2022 in this chart in operating income, which is the orange bar. The top line was also stagnating in 2022. The numbers have improved in 2023, mainly due to cost reductions, including laying off 2,000 employees in early 2023, representing about 7% of their workforce. Things are starting to pick back up again in 2023. Share buybacks are here, and they are big. But I discussed them. Let's move on. You can see the huge acquisition here in the middle of the chart. Other than that, cash keeps trucking upward even with the buybacks. All debt remains steady. Now, PayPal has more cash than debt. That's always a good thing. I bring this here for comedic purposes. Just look at the Mount Everest of PayPal's stock history. Can you believe that PayPal stock was above $300 per share in 2021? It's right there. And it just, wow. All I have to say is wow. Here's PayPal's last 5 years numbers. Revenue growth has been good and steady. For a value stock, this is what you want to see. This isn't the whole picture though. We need to dig deeper. Market cap, $66 billion. PE, 18. That's cheap. PayPal is priced for bankruptcy. 4 PE is even crazier at 11. That is super cheap, like crazy cheap. Pennies in the couch cushion cheap. It is insanity. They're priced for bankruptcy. They are priced for bankruptcy. Wall Street gives PayPal a buy rating. Average price target is $76.21. A 23% upside. Mine's a little higher. A high of $145. You think I'm that high? We'll see. Can you imagine if we get to that high again? Time for the DCF valuation. That's what you're here for, right? The valuation, and here it is. Now let's start with the basics. DCF is a valuation method that estimates the value of a company based on its future cash flows. Now the idea is to discount these future cash flows back to their present value, considering the time value of money. Now why do we use DCF? DCF helps us account for the fact that $1 today is worth more than $1 in the future. It's a powerful tool for investors who want to make informed decisions about buying or selling stocks. The present value of expected future cash flows is arrived at by using a projected discount rate. The WACC is commonly used to calculate the discount rate, although there are some other options. DCFs are commonly used by investors to pick stocks and also for, other purposes. Now, I am working on the assumption that Alex completely fails. I'm assuming that revenue grows at only 8% this year, 7% by 2025, and down to 5% in 2032. That's pretty close to GDP levels. These are apocalyptic numbers. 4 horsemen numbers. The 4 horsemen of the apocalypse are coming down and raining fire upon us. The worst case scenario. And that is what I'm modeling here. Now here's the worst case scenario in graph form. I'm issuing a PayPal a actually relatively high discount rate of 9.73% due to a combination of today's high interest rates and their volatility. Please note that the higher the discount rate, the lower the valuation. This value might be a little unfair though due to PayPal's stability as a company and the strength of the balance sheet. I'll just include my charts for the conservative case. With 3 quarters this year already wrapped up, there really isn't too much guesswork for 2023. I estimate that 2023 will come in at 8% growth, with growth dropping gradually to 5%. EBITDA remains flat, taxes remain flat, D&A and CapEx also remain flat as a percentage of sales. I'm actually using a WACC of 8% since the previous number was just way too high. Perpetual growth rate of 3%. This gives us an implied stock price of $96. Apocalyptic, isn't it? Here's the multiple valuation. The multiple is 12 because of the high margins that PayPal has. This gives us an implied valuation of $90. Also, similarly, apocalyptic. I averaged the perpetual multiple valuations to come up with the implied share price. Here's the conservative case. The implied share price is $92.98. I averaged the perpetual and multiple valuations to come up with the implied share price. Here's the conservative case. The implied share price is $92.98. So the apocalypse gives us an upside of 52%. Not bad. If you want to see my bull or base cases, head on over to my Patreon. You can see them for only $1. In wrapping up, we covered the ins and outs of PayPal's thesis valuation. Remember, valuation is both an art and a science. It requires careful analysis, informed assumptions, and a keen awareness of risks. If you found this video helpful, don't forget to like and subscribe. Thank you for joining us today on Finance Ninja. Thank you for watching, and I'll see you in the next one.